The toughest decision in investing is the selling. They just talk about buying.
You don't know really when to sell. They know how to get into it. How many people know how to get out of the bubble or the cycle?
Do you think that emotions also play an important role into selling?
So we are all loss averse, and that is why you look at conventional investment holds a lot of value in this world. People don't measure their investments.
Buying is easy and there are clear-cut guidelines to pick up the stocks, even the moments when should pick up. But selling is something tricky and I think people should.
We're in the time of AI, the time of the Bitcoin. But I think in the long run, in my opinion, value investing will be alive because it talks about the business.
Hello everyone, welcome back. Today we are going to talk about a very interesting topic on investing and which nobody talks about much and nothing much is written about in the books about it. Even the seasonal investors took it horribly wrong, and which is art of selling the stocks, selling the assets on right time. So to talk on this topic, we have our guest, Mr. Bhuvan Gupta, and we will go deep into this and we will try to break down the philosophy of art of selling. And welcome, Mr. Bhuvan.
Thank you, Arun. Thank you.
So there is a famous quote by a legendary investor, John Neff, who says the toughest decision in investing is the selling, right? So, Mr. Bhuvan, we are going to deep dive into the intelligence behind selling, why most of the investors make mistakes into this, and what is the philosophy behind selling, because most of the time we heard people, and there are so many social media accounts and people talking about it, they just talk about buying, how to pick the right stock, how to time the perfect timing to enter inside those stocks and market, but there is nothing much or less people talk about selling. So what is your take on this?
So Arun, there is a bias towards markets. So if you see in the long run, whether it is S&P 500 or Nifty, they only go up. Now, if let's say up to 66% time the market goes up, you will find a lot of buy side narrative or buy side analyst which will talk about only getting their brokerage made because of the buying decisions. Now, I think there was an act which is passed, and then now we have a lot of sell side analysts who also tell you when to sell. Now, so the most important thing is we are attached to our investments. And it is a difficult decision when you make 10x or let's say 20% or 40% return. You don't know really when to sell because everybody is behaving like Abhimanyu today. They know how to get into it. How many people know how to get out of the bubble or the cycle? So there's less written about selling. If you go to a lot of books, you'll find a lot of books about buying the investment or buying the stock, but very few books. In fact, Peter Lynch has talked about it in one of his books. Then Philip Fisher wrote about this in the book. So selling is a rare phenomena because it is the art which only Arjun has mastered over Abhimanyu. But I'm sure there are a lot of Arjuns in the field of investments from where we can learn how to sell and when to sell.
But why do you think this selling is harder than buying?
Because we get attached. So there are some effects like on the behavior finance we study, endowment effect. So if I ask you to sell your iPhone to me, and you probably will ask me for higher price than the new iPhone in the market, because things which I possess or I own, I value them more as compared to what is available in the market. So that's endowment effect. The second thing is loss aversion. So if you have a $100 portfolio and you have lost $20, at the same time you also make $20 somewhere else, the pain of losing the money is more than the happiness to make the similar amount of gain. So we are all loss averse, and that is why you look at conventional investment holds a lot of value in this world. People don't measure their investments. Fixed deposits and bonds are the bigger market than, and even gold for that matter, because people think that gold will only go up. And even I know I'm the wrong time to speak about gold, but there are cycles where golds have not made money. And the third thing is cliff investors. So cliff investors also, so there's a cliff investing behavior that people buy something for $100. They get very annoyed and very disturbed when it goes down 20%. They keep it to their heart. The moment it touches 101, they sell it.
That's
So
true.
there are a lot of this emotional behavior at play. The endowment effect, the loss aversion, these are a very important concept of behavior finance, which one should study. So I always tell people that before you study value investing, study behavior finance.
That's great. That's very, very valuable. But I just like to know what a normal retail investor does different, or let's say doesn't do different than a seasonal or experienced investor who knows a little bit art of selling. What are they doing differently?
So
than
Arun, a novice player, when he goes to attempt any sports, he just gets onto the court or to the game. But let's say a mature player, he does the workout, he does the warm up. After the play, he also do the cool down. Similarly, the novice retail investor thinks money is his. It is like treating yourself for a heart attack by looking at the internet and getting guidance from there. So similarly, what he does, I have been told I can start investing. There are so many of metro station today full with the all brokers hoardings. So what does happen is that they say, everybody is making money. What is great in it? I'll also do it. And market is actually like an ocean. It calls you, come. And people the people who do not know swimming, they get into it and they think we can swim well. And only when the tide turns over, we know who's swimming naked. So retail investor goes into it without studying. In fact, he knows the price of everything and value of nothing.
Okay.
That's the mistake he does. Where professional investor is being measured on a lot of parameters.
Fine. So you are trying to say that disciplined approach, and there is a structure, if every investor follow, they can survive, or let's say remove the fear of selling and all. But most of the time we hear and read that buying low, sell high, or buy and hold, or buy and forget. So sometimes, and even myself also as an investor, because I have some very, very novice level of idea about investing in Indian stock market. And most of the time when I feel like the stock market is going up, my stocks are going high, I say, okay, let's grab this, and otherwise I will lose more. And when after a few years, I see that those stocks have become 5, even 10 times multi-baggers. So what is your, let's say, mantra or philosophy that you want to guide to our investors or audience? That is this philosophy of buy and hold, or buy low, sell high, or buy and forget. What is your take on this?
No, so Arun, buy and forget is not going to work. It will only work if, let's say, you're investing into passive fund. It also works on those days when the change was very slow. Today, change is very fast. We're in the era of AI. We're in the era of information. Till yesterday, we were making the mansion on the land. Today, we are making mansion on the water. We reclaim the land and we make the mansion. So, when you buy something, you need to be very sure that you read about that business and you get to learn it more. There are 4 quarters, the 4 windows in a year where you can get to know what's happening in the business. So over time, you don't have to act on the screen. Be lazy in the screen, because cultures don't change overnight. And there's a saying that culture eats strategy over breakfast in a lot of companies. So you can't make a Coca-Cola Apple next day, or you cannot make, let's say, a company like IBM and Amazon tomorrow. So Amazon is Amazon, and it is a startup, and it's a culture at this kind of a $3.8 trillion or $3.2 trillion market cap. So what we have to be very focused with, buy and get to learn more about the businesses, and then probably hold it if the thesis is correct. So there are 4 kind of things when you probably look at selling, and I'll talk about it as the question comes in.
Sure. Okay. So if we think about, like, there should be a disciplined approach and there should be thesis, based on what is your rationale behind investing or entering into that stock, right? And if that is true, we should stick to it. If this changes, is it right? Yeah,
so everything is nothing is permanent. So I think you're talking about when to decide to sell. Is that what you're asking?
Yeah, I mean, we have seen, if I follow the same approach, like buy and forget, buy and hold. So I may see there are a lot of companies in the past, if I will, because people just give examples of today's, which company survive till today. We say, okay, if you have invested this much, you got to become the millionaire, billionaire. But there are few examples as well which turns around differently. For example, Kodak is there, Yahoo is there. There are so many other examples. But you know, the investors who maybe, if I got your message correctly, having this structural approach, the thesis and the expectations correct, maybe they may survive from it. So my next question is, do you think that emotions also play an important role into selling?
Yeah, so I think emotions is everything. If you look at, we're all emotional people, and you can never be happy all the time. Sometimes you're nervous.
Yeah.
Sometimes we are very, very happy, very excited. Sometimes we are sorrow, and we would love to cry. So let's say sometimes it is sorrow of happiness.
Yeah.
So if you have ever measured the tears are sometimes hot, sometimes they are cold. So even tears have the shades. So similarly, when we are not same, market is a reflection of our collective emotions. And on a particular day, if the market is feeling bad, everything is going down. It is like a situation you are handling, like an oil pipeline leakage happens. What will happen? The whole supplier or the vendor who has done the oil pipeline, they're going to the grill. The whole office or the whole division will go through a grim phase. Similarly, when the oil pipeline will be doing amazing, great work, and let's say oil price goes up and incentives are linked with it, there will be an excitement across the board.
Yes.
Similarly, market is nothing foreign. Market also behaves like a very good quote of Ramdev ji, that daru pi ke ghumta rehta hai market. So it is like a random walk.
And okay, about this, about the emotions and the how people take differently the investing approach. So there are different people. For example, if you ask me, when I see my money is growing on paper, the stock market going high, I feel happy. But when it's time to press that button of selling, I feel panicked. Is it the right amount? Is the right time, or should I wait for longer? Or when it start going down, I start behaving differently, and I start holding on to that oh, maybe it will come back, it will bring my money back to the same levels. So people show different behaviors and emotional attachment to stock market investing. So some people feel like I cannot take it. I cannot just go into the stock market and start looking at my stock every day. Some people feel like I will just invest in bonds and the fixed assets. Some investments more into properties as well. So how do you define those categories or type of investments investors should be look into, or what should be the ideal approach?
So the ideal approach of selling in the stock market, and you can also have a checklist for property and gold or all the other assets like alternative assets. So one is the broken thesis. So you should sell a stock when the thesis is broken. So let's say I invested, I have paid the promoter to expand the business in the field of AI, and he starts diversifying in the development field, the real estate field. So that's a broken thesis. So one should always look at the capital allocation. The capital allocation is very important. It should happen in the right place. Now coming to the better opportunity. Now sometimes what happens, you sell a stock because you have a better opportunity somewhere else. And that's generally when we do the selling. So you have a stock which is a company which is not growing, yet you're not losing money, but time value of money is going down. And that's the time to look at and move from that company.
Correct.
Sometimes you may go wrong. Like if you would have seen Apple's journey or Amazon's journey, many times in the decade you have not made money. Even in Microsoft, when the Steve Ballmer was the CEO, he did not make money for 7-8 years. So there is a possibility that you will not make money in these companies. But from a fund management perspective, you always have some good options or great options. So that's the better opportunity. Then the third B is the balance approach. So you would like to, so I sold a stock when it was 40% of my portfolio. So yes, I can still make money in that stock, and the stock has again run up, but I still sold that stock because the stock owned me now. So I had to sleep also in the night. So I will cut down from a concentration risk. And then the fourth thing is the ballooning valuation. Now, what is ballooning valuation? So you bought a company at PE of 5 or 10, and the company is now grown to 4 times in the earning. But the stock has become 16x because the price to earning expansion has happened and it has gone to 40. So Paycom is that stock. A lot of people recommended me to look into the stock and buy. And recently Paycom was at a 50 time price to earning multiple.
Beautiful.
The earning for the last 5 years has, or 3 years itself is doubled.
Beautiful.
But your return in the Paycom, anybody's guess is negative. Because you bought at a higher multiple. So when the valuation is ballooning, you need to. So one has to keep this 4B in mind.
Yeah,
the
very
balance,
beautiful. Yes.
the ballooning valuation, the better opportunity,
Yes.
and the busted thesis.
Here is a debate I most of the time come across. Selling a winner or selling a loser. So which balanced approach a investor, a retail investor like me who is having a regular job and very little time to invest, I can come back and spend half an hour, 1 hour on my portfolio. So what is your approach towards this?
So Arun, we can't look at this way that selling a winner and holding a loser or selling a loser. So look at it. Peter Lynch said that know what you have invested at. So if you do not know what you have invested at, you should not own it. So very important to know that if a stock is $10 value or let's say $1 billion valuation, it could be a more risk. But when it becomes 10 times up, it could be a lesser risk. Now that is something very foreign for a lot of people. So people think of stock market as a property investment. So if you own a land and if you keep it for some time and it is not appreciated, and if you keep it for some more time, probably you will make money. But in a stock, it is like a falling knife. If a $100 stock went to 50, there is no guarantee, the guarantee it will not go to 40 or 30 or 20 or 10. So it has happened in the Yes Bank, it has happened in Satyam, it has happened in Enron. So what do we have to understand here is that know what you own.
Perfect.
So sometime when you have, let's say you have a Netflix stock, you bought at $10, you made money, bought at 20, you made money, bought 40, you made money, bought 60, you made money. Why are you making money? Because your children, my children, your family, my family, everyone's family is glued to Netflix or YouTube for that matter. So unless and until we are glued to it, we're paying a premium as compared to the other channels or the digital subscription, we will continue to be rewarded as shareholder. So price does not define anything, Arun, in my opinion.
Okay, great. So next, I like to touch upon different approaches. For example, there are different investors who look stock by stock, and there are some investors who look overall portfolio. So me also, and our investors also want to dig little bit deeper about the approaches, different approaches investors take, and which approach fits for what type of investor.
How about if you become a multimillionaire and your friend is not? It is the same feeling that if your stock is making a lot of money but the portfolio is not, because you just bought 5% in that stock and the portfolio is much bigger or your overall portfolio is not growing. So I think it's a fun way of making money. It is like good time pass, killing of a time. We have to be very sure why are we coming to stock market. So I don't know about others, but my reason to come and make 100x or 1000x in the stock market. Buffett made his first billion at the 65 years of his age. Today at 95, he is worth 150, 170 billion dollars. And the most important thing is his calendar is still free and he still reads. So the most important thing we all have to understand that let's not measure our return in percentage. Measure the return in X. Now what is X? To divide a percentage by 100, you will get the X. So any idea Apple, Amazon or Microsoft in the last 30, 40 years from their listing of 1985, 1990s, if you put in $10,000, how much amount one could have made?
Maybe 10 to 15 times.
So that's where we go wrong. So great business people did not make money because they were intelligent. And Einstein said that imagination is bigger than intelligence, and that is the manifestation. Apple, Amazon, Microsoft have turned $10,000 into 3.5 to 4.5 million,
Beautiful.
which is
Huge.
3,500x, not percentage, x. Which means if today I invest $100,000 and if one company, and it has happened when I was in the Buffett Berkshire Hathaway last year, one lady was there, she was so happy and she got her 5 friends and they were very, very happy. And I asked, why are you so happy? She said she made 22 times in Nvidia stock. So that $1 million has become $22 million for her, and Arun, she is finally retired forever. So this is how the stock market will change the journey. And I'm sure, yes, property market is also booming in a lot of cities like Dubai, but they can't change the destiny like this. That's the stock market.
Okay.
So it's very clear, you should know why you're coming here.
So in that case, if I may ask, like can we classify individuals? Because I was hearing people categorize different type of investment, different category. For example, eagle type, sharks and all those, and eagle, lion, shark, and tortoise kind of approaches.
Yeah, there are many. There are rabbit.
So
There's a lot of them.
Is it a right and wrong type of approach in any of these philosophies, or
nothing right or wrong? It's all what suits you. So there are funds like specialization funds, then there are hedge funds, then there are long short funds, there are value investing funds. So we can talk about what eagle is. So there is saying that we all have an animal inside us. So what is that animal inside you? Figure it out. That is behavior finance. What is my behavior? So let's say I have a habit of telling people that I will not eat, but when something comes on my table, I'll eat. That's your behavior. And some people they would order and they say I don't want to eat. So everybody is different, right? Some people overeat, some people tend to undereat, some people eat on time. They're very particular about time. They're like time devotee. If it is 9 o'clock and 1 minute more, they will leave.
okay?
So similarly, eagle. What does eagle do? So eagle has a big vision. It can see things from far. It flies very high, and then it looks at its prey, and then it comes very fast. But generally, it picks up the dead animal. So are you of that kind of an investor?
Okay.
That you have a lot of vision, but when you pick it up very small quantity.
Okay.
Oh,
Makes sense,
I did a lot of research, everything. But then when you're buying a stock, just let's say $1,000. Okay, you have spent so much of time in visualizing in your vision
information,
and then what are you getting?
Everything. Yeah.
So the kind of thing you are getting, it is not multiplying your money. Now let's talk about lion. So lion or lioness, whoever hunts, they come very slowly. They come when everybody is sleeping, or let's say everybody is fearful. Then they get greedy. And then they come very slowly. The moment they identify that this is the right prey, then they hurry up. And they buy bulk load of it, and then they don't come back unless they're hungry, which means they take less decisions, but they take quality decisions.
Perfect.
So probably a lion is a value investor. Less decisions, bigger decisions, and very thoughtful, careful decision when the world is sleeping.
Right.
Then probably you talk about a rabbit.
Yeah.
Now rabbit is also enjoying a lot of carrots in the jungle. And the moment he sees, let's say something comes up, immediately will go down to his cave or a small bill.
Okay.
And then it will not come out. So these are the investors who probably will sell much before the crisis might come.
Okay.
Like Jeremy Siegel has been telling people for last 4 years, crash is going to come. So these are the rabbit kind of investors that they want to harvest return and they want to save the return. And then there are other animals. Elephant is there.
So can we classify these, let's say, fast movement, let's say rabbit kind of?
No, the fast movement is shark.
Okay.
So momentum traders, you talk about a shark. And you don't even get time when they'll hunt you. And it's very fast. So momentum trader was also very famous nowadays. So those are like a shark.
Because I see most of it right now in this age, because of social media and YouTube is now much more available comparing to 15, 20 years before, or even 10 years ago. Now people have much access to most of the internet content. So they try to grab opportunity which is fast, instant money, fast money. So I believe the momentum stuff is getting, more pace based on these
It has
information,
taken a
who
pace.
doesn't go deep into the analysis, study past history, the financial performance of a company, how strong is the moat and the model itself, and the company, what is it doing, right? So I believe right now people start to chasing these because they see, wow, man, let's chase the momentum and I will start making money, I will sell and I will buy, all these things.
Yeah.
No? So how you think this kind of approach is different and which is long lasting than the long-term investment?
See, long lasting is always, in my opinion, is value investing. Now, even in the momentum, somewhere there's a value investing. So let's understand the momentum investing first. So now they keep high speed server. So those who are in the cloud, they know that the how speed is important. So if you go to an internet website, the website is not working properly, you will go move to the other website. So speed is very important. Now there is a belief that if you have a data server which is close to the exchange, you probably will be able to get that information faster and click faster on a buy or sell. So a lot of this high frequency trader use the momentum trading. That's one. The second type of people who are like quant funds, they look at the liquidity.
Yes.
So there's a rotation of the liquidity. So if you see FII specifically in the Asian market, people watch their movement. Which sector are they going to?
Correct.
And they keep selling one sector, buying other sector, selling one sector, buy another sector, depending on the liquidity. And liquidity has various reasons why liquidity comes in a particular sector. And it's a sector rotation. Greed, fear, greed continues to move on. Now there is a greed indicator also nowadays. So momentum trading is good for people who are very sophisticated. Now in the long run, so let's say what happened. In India, one of the American hedge fund was doing this momentum trading. Brokers made a lot of money.
Yeah.
If you go and check the balance sheet of any broker, Angel or Share India, you will find a lot of money has come to them as a broker, because you have to leverage intraday before you can have because you make very small return. So you need to have a quantum manifold to make some money. Now what happened? Shark is killed. Shark was so dangerous. It has siphoned so much of money from retail investor that SEBI has just killed it.
Yes.
I'm sure you know about it. So in the long run, value investing is a win-win situation. If you buy a share of, let's say, a company which has done well, you buy at $10 and now you're selling at 20. I bought at 20 from you and I sell at 30. You made money, I made money. But in the quant or in the momentum trading, it might not be the case, because I am siphoning the, let's say, the food from those small fishes, which were happily eating at their zone, but now I just came up and eaten their food and they probably are dying, or they are the whole habitat is gone. So I think if you watch carefully, yes, we are in the time of AI, the time of the Bitcoin, but I think in the long run, in my opinion, value investing will be alive because it talks about the business.
True.
So business 100%. Is the soul of the
100%.
business of the stock.
In my point of view, I think the value investing is more solidify and start from the grassroots, and it's real. You can see it growing by yourself, and it's something real you can always grab, and nobody is at loss. Completely agree. So next we will go into people sell stocks, people sell their assets, and then the next move is to decide where to invest further. Or because sometimes this is a anxious feeling that am I keeping my cash holding in my account, or should I start looking for other opportunities and start investing? Do you feel that keeping cash is a bad habit?
No, keeping cash is not a bad habit, depending on why you've kept it. So let's say your daughter is getting married, or you have to send your child to the higher education. Now, I'm different as a professional investor, but people who are not professional investors, or they're believing or they're banking on somebody else, it is advisable to keep at least 8 months of liability as cash aside. Because market may go haywire for years. Like Indian markets have not made money last year. They have not made money in that period of demon. So 3 to 4 years, easily one cannot make money in the stock market. That's very common. The second reason is when the fear grips the market, people don't invest more. Today, everybody is feeling bad about India. And I think that's the time to be very, very greedy.
Yeah.
So I think cash is good. And if the purpose is solid, one has to have cash.
Correct. I remember I was reading in, I think, Reddit or somewhere, when people was posting their returns they bought stocks in COVID time 2020 or something, and they were showing as like multiples, and people were commenting like, oh, this is easy because you bought it in COVID time. I comment that it is easy to say now because now we recovered from COVID and now we are in a much better situation, but it was very tough in the situation of COVID when people was unsure about their own money or their health and everything, and you have the courage to take out your money and put into stock market. That intention and courage is something matters more than the return. So if somebody take out their cash, trusting the stock market or trusting the, let's say, country economy, and put their cash in on the basis of trust that in future it will jump back, I think that's something it's commendable.
Yeah, it is. But
otherwise, people keep cash because that situation was completely horrible.
Correct. So it is like if the stock market goes 50% down, I will probably put everything inside the market.
Yes.
Though I have everything inside the
Correct.
market because I believe in a philosophy of always remain invested. I'm a net buyer in the market.
Yeah.
So I don't carry cash anyways. But yes, a lot of people get into that time. The only challenge is who exited in 2020. Because he's still waiting for the market to crash.
Correct.
And probably that is a wrong approach.
Correct.
So it is very important to understand that market is not a one-time machine. In the long run, it's a weighing machine.
Absolutely.
Increase the weight of your company as a promoter and the stock price will just continue to price. So we have this company in our portfolio which has become 10x or 12x now. And now they have disclosed their investors, and a lot of this passive investment or ETFs have become part of their investment horizon. So basically, a lot of retail investors have come through the passive investment vehicle. And now I think that pool will just continue to increase. They have a daily volume of $100 million.
Beautiful.
We were talking about $2 million daily volume just 1.5 years ago. And now that company, even at $7 billion valuation, is less risky.
Beautiful.
So this is how the investing game is.
Absolutely.
Investing game is again not one time. I think there will be crashes again. People will buy in. But if you will just exit at 50% or 100% gain, it is not rewarding.
Yeah.
Let's focus on 10x.
Yes. And I think keeping that faith and trust is very, very important.
See, faith is important, optimism is important, but this is not blind emotionalism.
Correct.
There are many books, like books are here. Why don't we read the books?
Correct.
Because why don't we attend the Omaha Berkshire Hathaway conference? Why do we think that 40,000 people come over there and they're all millionaires or billionaires? Why are they coming? Because I think there is a two-way people work in this world. One is they work with their time. And there's a terrible way of working that I am overworking every day like a labor to make money.
Yeah.
And the other way is that let my money make money.
Correct.
But only 5% people understand that. And those 95% will never understand.
Perfect. So let's end this with a practical playbook. What tools and habits can investor actually deploy to be better in selling?
So in the selling, there has to be the way you have a checklist for buying. You have to have a checklist for selling. Now, first thing people should do is that they should understand that what am I buying? I'm buying a stock as a commodity or I'm buying a business. If you're buying a business and you're hooked to the product, so I will ask you a question. Do you have Apple products at your home?
Yeah.
When are you going to stop using them?
I don't think so.
If you do not know the answer, then probably you need to continue to know why do you own these new Apple gadgets and why are you getting more glued, because Apple is the ecosystem. It just grabs you. Similarly, till yesterday, I was the, let's say, the customer of Amazon, the Amazon Shopping and Amazon Prime.
Amazon Now also.
Amazon Now also. So now I've become a customer of Amazon Now. I already have an Alexa. And will I be a customer of Amazon Cloud? Probably yes. If I have become an enterprise, I have an app, I have to have the Amazon Cloud. So until I am under the ecosystem, I'm buying those products because they're cheap, they're quality. Probably that is how one should think. It's a very simple question we should ask all the businessmen. When are you going to sell your business? If you don't have an answer for that, why are you thinking in the stock market that you will invest now and exit in the next 1 or 2 years?
Beautiful.
Take out your profit if you need.
Yeah.
So the checklist is this. Then the tool there are two books which have mentioned about the selling, which is the Philip Fisher book, which is the Common Stock, Uncommon Profit. There's a selling section one should read. And then there is a Peter Lynch who has written about the selling stocks. And there are different playbook for different kind of a stock. So if you're in a cyclical stock like gold and silver, probably it's a time for us to revisit how we need to probably exit the gold and silver.
Absolutely.
But if you are into gold and silver mining, you still have a runway. Now it depends which kind of company have you bought in.
Yes.
That's one. So cycle you need to understand. Probably this is a good time to look at crude oil.
Yes.
Are you aware of what is the 5-year return of crude oil?
No idea. I don't know.
So I think you should have that idea. Yeah. So 5-year crude oil price crude oil has made nothing for people. In the
last 5 years, no.
So that is a great thing because that's how I'll have input cost low. And probably when the oil price will go up, a lot of companies will make 2x or 10x returns. So it's very important to understand the cycle. Cycle is the key. So then you should join some courses. There are courses happening in Columbia University in America. There are courses happening, in-person courses happening in the Flame University, where they specifically teach art of selling.
Beautiful.
So I think Kuntal has one very good researched presentation on the net. He also teaches this course in CFA Society and Flame. So people should attend that to understand which kind of investor they are and how the selling is. And there are other books also on selling. So one should look into it. I have also looked into it last 1 year, and I have also sold a stock at 40%, I just told you. And then I also started reading the books. But I think in my mind, selling is very clear. Yeah.
Beautiful. But I think, in my point of view, selling is the most important part in the whole investing philosophy, or let's say the journey of yours. Buying is easy. You can learn so many things, and there are clear-cut fundamentals, clear-cut guidelines to pick up the stocks, even the movements when should pick up. But selling is something tricky, and I think people should invest time. And
selling
learn.
is messy.
Yes.
Because sometimes you don't get the price also, you don't get the liquidity also. But buying is equally tough. So I take a lot of time in buying. And that's why my selling is easy. But if you have not, so I believe when you make money when you buy, not to sell. Because I generally prefer buying great quality company at lower valuation. I still go wrong. But comparatively, I go wrong very less number of times. So if I do not know how to pay a discounted price for a quality asset, then selling becomes very important.
Correct.
Yeah. So it is an arbitrage.
Great. Very nice. So next topic, we will jump into our rapid fire. I think I will ask you some quick questions and request you to answer them as the best of your experience and knowledge.
I'll try my very best.
So the first question is, one reason to buy?
To make 10x, 100x and 1000x.
Okay. Next question is, one reason to sell?
Corporate misgovernance.
Okay. Beautifully said. Third is, biggest enemy in selling?
Your own emotions, the ego.
Absolutely.
The disposition effect also, there's a one word that how long you hold it, you start getting attached to it. Yeah. There's a famous saying, Dilaya gadi pe to pari kya cheez hai. The stock which I own with the endowment effect, this happens with all of us.
Yeah, that's true. One rule every investor should tattoo in their mind.
What journey are you traveling? Why are you here?
Okay.
The goal, the end point in the mind must be clear.
All right. So that's the end of our session today. Very beautifully mentioned everything you have, and it was, I think, privilege for me, and I think our viewers also, to share so much insightful thoughts from you on the most important part of the investing journey, which is selling. Thank you so much, Mr. Bhuvan. Thank you so much, and it was a pleasure having you here. Thank you so much.
Thank you, Arun. Thank you for having me.